topic of discussion here in Washington, D.C. is the impact of disruption and uncertainty and what that's doing to business and consumers.
Europe has weathered the pandemic and the Russian energy crisis very well because of excellent policy intervention. But the recovery is progressing, but it's weak and it's facing headwinds. So consumer spending is there with higher real wages. We are now expecting that investment demand is going to pick up with lower interest rates and easier financial conditions. But headwinds have made the recovery difficult. And the latest headwind, of course, was US tariffs on the EU.
Everyone's navigating a world of uncertainty and fragmentation, but they're doing so with, I think, some more optimism than one would think. I do think there is a rewiring of the global system, new trade flows, new economic business relationships, new capital flows. So I think people are moving on. We've had 6 months of hand-wringing and anxiety. I think people are now looking for new business opportunities.
How different is that to the past? Was there a real reliance on the United States and China as just the major trading alliances?
U.S. for final demand, U.S. and China for so many other inputs and outputs, right? Deflation of what they exported. So I think everyone is looking for new relationships, new geography of how to do business.
Are there any clear early winners from some of this rewiring?
Well, the Gulf states have money, they have interest, they want to build, they want to be technology savvy. We see that in the UAE, we see it in Qatar and Saudi Arabia. I think it's quite interesting. The Africa continent is looking to be relevant, and obviously the ASEAN countries want to be the replacement for China in terms of manufacturing production.
We've had a lot of conversations so far this week about the impact of trade tariffs, and the view is that there still could be a threat to come, that the policymakers are on watch just in case of the feed-through. What are you hearing and what are you anticipating that tariff impact to be?
Well, everyone's hopeful that we reach the apogee in terms of size of tariffs from the United States. I don't know. You know, the president signed many MOUs, there are still many to be negotiated. I don't know how durable they are. I don't think I'd put a lot of stock in them existing for a long period of time. I think I would look past them again, look for new relationships, new sources of capital, and new destinations for your products and services.
We've seen a lot of risks, upside, downside risks, lots of things changing geopolitically in the trade area. But with regard to the numbers we get in the projections for the inflation rate, for the growth rate, and also what we get from financial markets, we see quite some stability. And as long this is there, I think we're in a good place regarding the interest rates. But of course, things might change quickly. It's important to keep your powder dry and be able to act at any moment in time when things might change, when we need to change, and that's the reason why we have a meeting-to-meeting approach. We look at the data, and the new data that comes in tells us whether there might be changes or not.
Gold has always been a kind of hedging asset against high levels of uncertainty. And of course, when we look at policy uncertainty at the moment, so for example, news-based uncertainty measures, those are very high by historical standards. There's tariff uncertainty that is high, there's broader fragmentation uncertainty. And so we really view the run-up in the gold price as a reflection of those broader concerns about uncertainty around the world, really.
I think it's probably more on the growth front than inflation front. Of course, at some point it becomes a combination of the two, but our economy has been very resilient, that's a surprise. But also it seems to be that their capacity to grow again has been reduced. So most of the adjustments seems to be going on in the vacancy rate, where the unemployment rate doesn't move that much. So yes, I mean, if anything, probably the risks are more coming from the US as they've been for the last 2 quarters.
The key thing for me is that as Chancellor, I'm determined almost to be honest with people about the challenges that we face. And I think people can see the changing global environment we're in, whether that is Russia's ongoing aggression in Ukraine, the disruptions and the tensions in the Middle East, or indeed the impact of trade barriers increasing throughout the world. And I will respond to those as a responsible Chancellor at the budget in November.
I am only a central banker and an independent central banker, so it's not up to me to comment the political situation. But let me say briefly that the political uncertainty receded yesterday, which is rather good news. After reducing political uncertainty, we now have to reduce fiscal uncertainty. And it's important to understand about what the discussion is in France at present. It's not about Europe nor the euro. The political support for the euro is at record high, 79% of French citizens across the political aisle. It's not a question of recession because, as I said, the French economy is rather resilient. It's a question of how to reduce fiscal deficit. Here I am extremely clear. We have to reduce our fiscal deficit to 3% in 29. We had the first step this year from 5.8% to 5.4%. It's encouraging, but we must go further with a significant step next year with the 26 budget. But again, it's a discussion a bit about the pace, more about the how and the political mix. This is not up to the central bank to decide, but it's our national interest to reduce this fiscal uncertainty. May I still add one word on the economy? Traditionally, when there is fiscal tightening, people fear the negative Keynesian effect on growth. In our case, it's more than compensated probably by the reduction of the uncertainty. The savings rate of households in France is very high. So if we can reduce uncertainty, bring more confidence, to give you an example, if we reduce the savings rate by 1%, we would increase GDP by 0.4%. So it's a very powerful lever.